Okay, you're with us here on Quarter Se Quarter Tak. We are taking stock of what the first quarter of financial year 18 will look like in terms of numbers. There is the GST impact to take stock of, but will the market look through all of it? That's the big question. Let's start now in this segment with the heavyweight oil and gas sector. Large weighted sector. Varinder Bansal is back with us to tell us what we should expect from this space. Varinder, over to you.
Well, thank you so much. With all the backdrop which is flashing on the screen for oil and gas, the trends in first quarter, I'll start with Reliance Industries, which is expected to give a subdued quarter. GRM expected to be nearly $10.8, $11 per barrel compared to nearly $11.5 last quarter. Oil and marketing companies, of course, we've been hearing about inventory losses, strong INR, which could impact the numbers. But on the other side, the robust market volumes and also the staff costs, which will go down this quarter, are expected to cushion something. So watch out for GRMs very, very closely. IOC will be the only company which will have better numbers this time if you compare quarter on quarter, because the base quarter had many one-offs for IOC, so that could be picked in terms of OMCs. Upstream companies, again, solid quarter expected this time, only because the last quarter had many higher costs, royalty charges, and hence this quarter will be good. For ONGC, we expecting net realization to be around $50 to $53 compared to nearly $55. Among the city gas distribution companies, especially IGL, keep an eye on the volumes, which is expected to grow by nearly 9%, which is good. Petronet LNG expected 6% growth in terms of quarter-on-quarter increase because of the PNG, the Dahej volumes. And GAIL is expected to report EBITDA, which could be up by nearly 10 to 13% quarter-on-quarter. And also remember, GAIL was impacted because the base quarter had many in-payment charges.
Thanks for that quick rattling off, Varinder. Nischal, what will be your pick of the pack?
Obviously, Reliance is our been a long-term pick basically out there. We continue to remain positive. For a long period of time, I think Reliance is work in progress. The capex that is now coming into fruition, and for the next 3-4 quarters, especially on the oil side, basically more and more projects are going to go live. Simultaneously, I think the undervaluation in the geo space is also sort of getting sorted out. So we still continue to remain positive on Reliance, though the stock has run up quite a bit. But I think on dips, this should be a good pick.
Okay, so oil and gas and now cement. What will cement companies really report? Nigel is here with an update. Nigel, over to you.
Well, watch out for a good quarter coming in for the cement companies. Remember, pricing has improved both in west as well as the east part of the country. They're up between around 10 to around 12%. The demand has been more or less muted in the north as well as South India. Volumes on the whole, though, are expected to climb by around 5%. Focusing on individual stocks, Big Boy, UltraTech Cement, in terms of volumes, no great shakes for them. But in terms of profitability, it should look good because realizations will come in higher, though pet coke prices have spiked up as well, which will limit the profitability gains. ACC and Ambuja, they should deliver a good set of numbers, coming off a low base. And in fact, for ACC, we have higher volumes as well that will play out. What will look like a muted set of numbers will be from the north-based players, the likes of JK Cement, JK Lakshmi Cement, as well as Mangalam Cement. While in fact, in terms of Shree Cement, if you take a look at it over there, volumes will come in higher because they have capacities coming on stream. However, EBITDA per ton should take a hit because pet coke prices have spiked up.
Thanks for that, Nigel. Sanjeev, best cement stock?
Yeah, so unquestionably UltraTech and Ambuja. Ambuja should have a very good base effect, and they've seen a strong, uptick in pricing power. So I think that can surprise on the upside more than UltraTech. But UltraTech should be the market leader on the back that I think higher pet coke prices has already been priced in last quarter, and in this quarter, in fact, they should get better margin utilization on that front. As the dark horse, JK Lakshmi Cement on any decline would be a very favored play because their input costs have been the lowest in the mid-cap section, and we think that on any decline, in case numbers are weak, should be a good buying opportunity.
All right. Thanks. So with that, let's get to the big 30% of the market sector, banks. Obviously, the focus is going to be on higher provisioning because of the 12 companies being sent to the NCLT. But that will be in the quarters to come. Let's see what we are getting in Q1 from Abhishek, who joins us with an update. Abhishek?
loan growth has remained in single digit for banking sector. So loan growth pressure will continue in PSU banks and expect majority of them to show a YOY decline in their loan growth. However, three key banks, that is the large caps of SBI, PNB and Bank of Baroda, showed a strong loan growth momentum in the previous quarter. Whether that continues or not needs to be seen. Elevated provisions will eat into the earnings of PSU banks, and many of them can report net losses even in this quarter as they did in the previous quarter. Elevated provisions will also continue for private sector banks as RBI has changed norms to 50% requirement of provisions in the top 12 stress accounts, and how that pans out needs to be seen. One key account, that is Jayaprakash Associate, has come out of the restructuring phase and has become standard account. So key beneficiary of this account is Yes Bank and Axis Bank. Back to you.
Abhishek, thanks very much. The wait continues. When will the quarter come when absolute GNPA start to fall? I don't know. It's unlikely it's going to be this quarter, but let's get our guests in. Dhirendra, in terms of banks, where does your preference lie?
Our preference has been to corporate banks. So we have been liking ICICI Bank for quite some time. So that's one thing which is, I think, playing out, and hopefully with the recovery in economy and credit growth, one should expect better numbers. The other one is SBI. So I think the provisioning moves are still there and probably will continue, as you said, through the rest of the year. But having said that, all we are playing on some bit of recovery in the lending space, and therefore these are two best places to be in right now. And so these remain our preferred picks. As we have seen that, retail lending has also to some extent slowed down in very recent time. Hopefully that will, recover. So there are also interesting, likes and dislikes. So we always liked IndusInd Bank earlier, and then SDFC Bank. But I guess we have to be very selective. We have to be very choosy given the uncertainty in the provisioning aspect. But preference will be, of course, ICICI Bank, SBI, SDFC Bank, IndusInd, and Yes Bank. So these are some of the banks that we have liked.
We would love to go on with this discussion, but unfortunately, we are not sure we will have time to get an advice from each one of the guests. Let me first finish Anisha's take on capital goods and infrastructure space, and then come back to you, gentlemen, for your advice. Anisha, go ahead.
Well, yes, for the road sector, the award has been slowed down about 40% year on year. But on the flip side, the urban and metro orders have picked up. And that is why I'm expecting a 5% growth for the entire sector. Moving on to the utility space, the PLF has been pretty well flat year on year. Yes, NTPC did record a very tepid growth. But for the others like Adani, JSW, CSC, they have reported a decline. And that is what I'm expecting from the rest of the sector as well. Capital goods, yes, there was a bit of uncertainty regarding GST. But the ordering has been strong for the likes of Larsen & Toubro, Bharat Electronics and KC International, and also for Larsen & Toubro, we are working with a top line growth of 8 to 10%, whereas Cummins and EBB also are expected to post healthy numbers. But the space really to watch out this quarter is the consumer durables. Remember, in May it was a washout month for the companies. June as well, the beginning was a bit slow, but towards the end, because of the discounts, etc., we saw a lot of offloading of the stock that happened, and that is what is expected to come into numbers as well. Maybe the margins might deplete because of the high discounts, but nonetheless, a key thing to watch out for. Back to you.
Wow, Anisha, that's a lot of sectors. I doubt we'll be able to squeeze in much. Nischal, your pick in the capital goods space?
So we continue to like Ingenious India out there. We continue to believe that there is a big capex which is coming in the oil and gas space, and if you speak to any of the oil marketing companies, they are all looking to upgrade their refineries from BS4 to BS6. And again, given that there is a 6% growth in the consumption, India will start running out of refining capacity basically by 2020. So we believe that that big space is opening up, and EIL is obviously the best choice.
Okay, Sanjeev, consumer goods.
Yeah, so we think, Voltas and Blue Star were very good plays, but We had a very good buy on them when the summer was expected to be warm. That has played out well. The stocks have run up, but the last month disruption notwithstanding, we would still be overweight those two stocks. And on the consumer electricals, we think Havells can be a dark horse which can actually surprise the street on the upside, with estimates going very, very positive. So Havells would be the top pick in that space.
Okay, I would have loved to ask you guys PSU banks as well, but out of time for the moment. We are taking a break, but we are coming back. There are still a few sectors like textiles and telecom, and of course our guests for more advice.